Hey, Bulls and Bears, we are back with another dose. Let's go ahead and get into the economic reality. I took 2 days off, so thank you for coming back. We got a lot of news to get caught up on because of the time away. I am refreshed. I got a little more sleep than usual. Usually during the week, since I'm still working, work full time in addition to doing YouTube. Usually during the week, I only get between maybe 4.5 to 7 hours sleep most nights, usually between, more specifically, probably between 5 and 6 hours sleep. So usually looking kind of burned out, I think, on a lot of these videos. Um, but I feel good today. I had some sleep here, but it doesn't take away from the reporting. So let's go ahead and get right into it here. It's starting to get warm here in my neck of the woods. I'm in a city called La Mesa, California, and what today it got? Did it get 90? Felt like it was in the 90s, but this upcoming week is going to be beautiful. Low to mid 80s is going to be the high. So very lovely time of the year, in my opinion. It does start getting really hot though in August, September. But very nice, what's going on here. But let's talk about the economy. The economy, it's inflate or die at this point. With the people in power right now, the central bank, they want to keep this economy looking good. Most people aren't agreeing though with the narrative that's put out there that the economy's strong, that the consumer's strong. We've got people out there like Janet Yellen recently said the debt is sustainable, and as long as we can stay at this level, we're fine, which was ridiculous. We talked about that in our last report. Nothing is staying level. They're throwing more and more money at this economy than I've ever seen and that you've ever seen. If you just look at the numbers, the accumulation of debt, how fast it's increasing, it's like a stack that goes exponential. Pretty soon, you're going to see just straight up and down surge in the amount of money being created, and that's going to be when it all falls apart, and it will be very quickly. I mean, this could be a you wake up one day and the dollar's lost 50% of its value type of thing. These things, they go up faster and faster. Then, boom, things hit a wall typically, right? So, will we see that, or will the level of manipulation be enough to keep things looking normal for a long, long time? I mean, I think this year is going to be it's going to be tough to get out of 2024 without some sort of crisis. We got over half the banks right now that are. It's not just me now saying this. It's a lot of articles out there, a lot of economists, a lot of even regulators are out there saying they're warning these banks are likely going to be facing insolvency, right? But then it's impossible to predict the level of rescues and programs and money that's going to be thrown at the banks. So that's what makes it very, very, very difficult. We don't know what the powers that be are going to do to keep this system stitched together, to keep the banks propped up and operational. So it's a very tough time for a lot of people, right? How do you predict a completely manipulated economy, right? People never thought home prices would go up this high, especially the people that lived through 2008 and they saw the enormity of the home prices back then and how they were so far detached from incomes. Now we're way above that. Not just the actual price, but the detachment and the separation between incomes and the home price, right? But there's so many things besides incomes that go into what creates a home price or what makes home prices go high and remain high, right? And we talk about those here all the time on this channel, right? So most of you know that it's not as simple as some people make it out to be. It's not just about incomes. If it was just about incomes, home prices would be down 70, 80%, right? It's about borrowing money. It's about programs to keep people in their homes. It's about billionaires buying homes. Look at the Blackstones and the BlackRocks of the world. And we're going to talk about that here a little bit later in the video. But let's start right here. This is an Olive Garden CEO. He came out there and said, because fast food is so expensive now, he's seeing more people go back to his restaurant. He's seeing an uptick, right? Normally, when people start getting in this amount of debt that we're seeing right now, as we're seeing credit card defaults are increasing, car loan delinquencies increasing, repossessions increasing, foreclosures increasing, everything's rising as far as delinquencies, defaults, late payments, all that. You would think a restaurant like Olive Garden would be losing customers quickly, but it's just the opposite. Because fast food is so expensive, people are looking at their bills that they're paying for McDonald's and Burger King and these fast food places, and they're saying, "Why am I going to pay whatever it is. Let's say you're one person, you're spending $20 for a meal at McDonald's. Maybe a family of five, you're spending $40, $50. And you're looking at the bill for a fast food place and you're saying, why don't I just go to Olive Garden for a few dollars more? I could have a nice sit down meal. Of course, there you have to leave a tip and stuff like that. But it's very interesting that he's saying that. Darden Restaurant CEO Rick Cardenas said fast food inflation has benefited his franchise as well as other sit down franchises. Thought that was very interesting. And I think I mentioned on this channel what I've been doing to kind of fight back against these high fast food prices and just restaurant prices in general. I've been cooking out more. $30 to $40 worth of food that I get to cook on the grill on the weekends. Last 2 to 3 days, it's like Tuesday, sometimes even into Wednesday, we're still eating the leftovers. And this would be the price of just one meal for a family at a restaurant, right? And we're eating for several days. Now, that's not all we're eating. So there's other meals in there besides what I'm cooking on the grill. But we've really cut down on the fast food and just restaurants in general. Not that I used to do that a lot anyway. I don't think it's the healthiest thing. In fact, I know it's not the healthiest thing. But just trying to fight back against some of this ridiculousness out here, like the $20 hour minimum wage. My son, actually, who's going to be entering the workforce probably here in the next few years, is getting to that age. He's really excited about the $20 an hour minimum wage. And I was telling him, well, I hope these restaurants, a lot of them are still around, having to pay these wages. We're seeing a lot of them close down. And it's another topic we talk about quite a lot here in this channel. But let's transition here. And this trade that we talked about here a few days ago that I got into, I'm shorting Nvidia stock. And I'm doing it via put option, right? So it's actually making the news. We timed this thing perfectly. I know more than one of you reached out to me and kind of got some information. We talked a little bit about this here. Nvidia stock in the spotlight after a drop from record high. We call it right about the top here. So we're already up pretty big on this trade. I got a put option that doesn't expire until August. There's plenty of time for that stock to go down more. The break even price for me to start making money is that the stock has to drop by like 18%. So we're already almost 10%. So I think we're going to be doing pretty well in that trade here. Well, let's get into, speaking of trading, it's interesting. I was watching a YouTube video on a supposedly stock market expert and went back and watched several other of his videos. Didn't mention any trades, didn't really give anybody advice how to make money, how he was trading. It's very interesting that these Wall Street experts, stock market experts, when you watch their videos, they're not really telling you much as far as actually how to make money. And also, I see some advertisements here, not to digress too much here. Some of you may have noticed the ads that come up in my videos and other financial economic channel videos. The ads that come up, I'm seeing a lot of these ads come up now. Example, a guy will get on the screen and he'll say, last year I made $500,000 in the stock market. Here's how you can do it. Buy this course from me. All right. Just stop and think about that. If someone's making $500,000 in the stock market, why are they trying to get you to buy their course? It doesn't make any sense at all. I can't imagine that any of my viewers would be lured into buying some stock trading program when you can just watch channels like mine and see how people are making money. And I'll tell you if I lose money, but it's been very rare. The last 2 years, I think I've been up a lot trading. I'd have to say last year, amount not dollars, but percentage wise, I think it was a 100% gain in my investments, right? But I'm all over the place. I'm in cryptos, I'm in stocks and put options. Still have gold mining stocks. A lot of, if you just look at metals too, precious metals, those are up bigly. Since we started talking about it here, those are up 100%, especially silver, right? So it's interesting though when you see these people saying, buy my course because we're going to make all this money. Yeah, and these people, if you're making $500,000 a year in the stock market, you're not going to be making videos to get people to buy your course. And the guy that I watched, this commercial here earlier today, watching some other YouTube channel, and this video popped up, this advertisement. The guy that said he was making all this money and wants you to buy his course, as he was saying this, he was looking down at his talking points. So he was reading off of notes, telling you how great of an investor he was, how you should buy his course, as his eyes are going up and down, reading what he has to say to you, right? Complete scam. I mean, I think half of these people, maybe most of these people, putting out these trading courses and videos aren't even traders, right? So I'd be interested to see the content in some of these stock market gurus courses. Maybe I'll buy one just to see what the content is. I'll let you know if I end up doing that. Let's talk about this here. There's more and more reports about people getting swindled out of their money. Report here: two seniors swindled out of $400,000 worth of gold. The scams are really picking up. They're really picking up. And a friend of mine that runs a gold buying business, he's got one here in San Diego. He's got one in Florida. He let me know that he just hopefully he'll get the person that did this, but he was kind of scammed. So what happened was a gold buyer came in and bought a lot of gold. I'm not sure how much, but it was a good amount, and paid via bank wire. And then shortly afterwards, he reported the bank wire as fraud. So what I guess his bank did, the customer's bank did, is they froze the accounts of the business, of my friend's business, while this whole fraud thing was being sorted out. So I'm hoping it works out good. I think it's still open right now and pending because I haven't heard anything back. But there's a lot of ways out there people can scam you out of your money. That's just one of the reasons why I would encourage people to think about not keeping all your money in an institution, because anything could happen. Not just fraud, but the bank could say, okay, there's suspicious activity. We're going to freeze your funds. Maybe you're accused of something that you didn't do, and then they freeze your account. All your money's frozen, right? Just a lot of things can happen in the digital realm. The push of a button, your money's inaccessible, right? So just one of the reasons why I encourage people to have something out of the system, something buried in the backyard, in a safe. There's downsides to that too. There's risk of that too. If somebody finds out you have a bunch of money in your safe, all those things. So be aware of your surroundings and all that good stuff. Millennials have it bad financially, but Gen Z may have it worse. So the younger generation, we know that millennials. We've talked here quite a lot about the millennial situation. Many of them can't buy a home. At one point, there was close to half millennials living with relatives or living at home or having to have roommates. But Gen Z may have it even worse. Today's young adults, put out by the Post, today's young adults are spending more on housing and car insurance than millennials did. They're also more likely to be in debt despite higher wages and more jobs. Yeah, because these jobs really, are they paying enough to keep up with the cost of living? But a lot of this job growth, these jobs aren't paying that much, folks. And especially when you look at the cost of living and inflation, and the jobs numbers they put out are phony to begin with, right? They usually get backwards revised the following month. But even if they were real numbers, even if they were accurate, look at how much they're paying, right? It's not enough. And you see the generation of millennials, we talked here a lot about how bad they're doing, how stressful it is. They can't buy a home. Some of them are, but for the most part, they're not doing what the previous generation did, and that previous generation is not doing as well as the previous generation. Things continue to get worse generationally, and the next generation. I mean, are things going to change? There needs to be a complete reset. We're not talking about the Great Reset. We're not talking about the reset that some people around the world want to have happen, like this whole digital currency, central bank digital currency, complete control. Things could get so bad though, where people will accept anything, right? If people get desperate enough, they'll drink poison if you tell them that after drinking the poison things will get better, right? So it's pretty scary, the direction I think that we're headed, how things continue to get worse. And we've said here things will continue to get worse. People at the beginning said we were crazy, you're nuts, that this is all going to correct, that the home prices are going to crash, and everybody's going to go out and buy a cheap home, and things will be great again, right? But now we're seeing things get more unaffordable as we go along. And believe me, I would love a crash, I would love a correction, but it's going to take something big and massive to bring this down. The banks, the powers that be, they're going to be pumping so much money into this. You're going to see the debt explode. And speaking of that, here, speaking of keeping markets propped up, recent article, 24/7 Wall Street. Housing prices weren't supposed to do this, but did anyway. Talks about the median home price continuing to go up, new record highs as we've talked about here recently. Median home price, and we're seeing different figures out of different reports. If you ask the National Association of Realtors versus Realtor.com versus Zillow versus Redfin, they're all going to have their own prices. 435,000 though, median home price, new record. I think again here we're the only channel that told people there was not going to be a housing crash. The last thing they want to do is have the housing market crash, because what happens with the housing market happens with the entire economy, right? So they're going to do is what they can to keep this housing bubble going, keep the home prices elevated. All right, we got zero down payment mortgages back. Talk about it here quite a lot. You guys know all the scams they're doing right now. Freezing foreclosures for a lot of people, not just since 2020, but even today. Programs are still in place so people don't get foreclosed. Um, Even with higher mortgage rates, we're not seeing the home price housing market correction like so many people predicted. Right? We've also got a lot of investors going out there, institutions buying homes. In California, it's about half the homes are bought by investors, and most of the time it's big institutional investors, right? On that note, let's take a look at some recent information out of BlackRock. For those of you that don't know, I'm sorry, Blackstone. For those of you not familiar with Blackstone, they own over 84,000 homes. And we see reports where they go out and buy thousands of homes, entire subdivisions in one sweep. They're in the news recently. They've recently foreclosed on some apartments. And so these apartment owners get loans. And in this case, not only does Blackstone own properties, they're also giving out financing to other companies to go out and buy multifamily properties, dwellings, etc. And you see that they're actually foreclosing on some of these apartment buildings right now. This is pretty interesting. Now, still on the topic of real estate and housing, I think a lot of you may know that Canada has a home price problem or housing bubble even bigger than the US. Home prices are even more overvalued there when you look at the fundamentals, the incomes, and historic home prices. Look what's happening in Canada here. Canadian mortgage delinquency is up 24%. 24%, folks. This is a year over year number. That's a lot, folks. Canadian households are finally starting to realize why so many agencies warn against borrowing so much debt, taking out so many loans. A new report from Equifax Canada shows that households are struggling to repay their supersized debt loads. Imagine that. I'd be interested to see in Canada how many investors versus how many people actually own their homes as owner occupants, right? It's very interesting. Pretty much the more investors own, the less you're going to see the housing bubble go bust, because you're really not seeing a lot of um, big investors going bust, right? You're not seeing Blackstones, BlackRocks, Invitation Homes. You're not seeing many of them go bust, so they can weather the storm very easily. And in fact, if home prices go down, that might be the majority of the buyers, is the big billion-dollar, multi-billion-dollar companies. Another 12-year high for credit card charge-offs and delinquencies. 12-year high. Does that sound good to anybody? Is that a strong economy? Is that a strong consumer? Credit card charge-offs and credit card loan delinquencies continue to be at a 12-year high, according to the Fed's first quarter report. Data indicates charge-offs increased up to 4.2%, and that's the most recent quarter. Of course, the second quarter, we're not done with that yet, but we will be in a few weeks, and then we'll see what the numbers are. And I'm guessing here, I'll give you a few seconds to guess what I'm going to say. It's going to get worse. The second quarter is going to be worse than the first quarter. Again, how long can he keep this going? What's going to be next? Is it going to be credit card forgiveness? We already have the exclusion of medical debt off of credit reports, because people had so much medical debt that it was ruining their credit. And of course, they don't want people's credit ruined. They want people to still be able to borrow more money, because borrowing money is how they keep the economy looking good, right? If people can continue to go into debt, the economy can continue to look good, right? It's when people can no longer borrow money, either one, something happens with the banks, or people just get so maxed out where even banks that are propped up are not going to give them money. Let's see what this says here. Speaking of other countries here, we just talked about Canada. What's happening over in the UK? Look at this. It's even worse than the UK, even worse than Canada. Home repossessions are up 50%. 50%. So even after all the shenanigans, keep the market propped up, they weren't able to do it in those countries. Is the United States next? Are we the next domino to see this correction here? 25% increase in Canada, 50% increase in the UK. There's more videos out about tow truck drivers. I showed you guys the one last week about the guy that was getting his car taken, or they tried to take his car, and he sat in the car and just revved up the engine until I think the engine blew. Well, tow truck drivers are out now. Um, the article says here, tow truck drivers are out there giving interviews on the dangers of their job. As car repossessions increase, tow truck driver speaks out about the dangers he faces. After his hand was run over while he attempted to repossess a car, a tow truck operator gave up on repossessions, right? So it's becoming a more and more dangerous job. And people that are losing their cars, obviously they panic because when you're living paycheck to paycheck, when most people live paycheck to paycheck, then you lose your vehicle. It's only a few days missed work. You don't have a ride to work, can't get to work. It's only a few days and you're done. You're whatever. You're not paying your rent. You're back home living with mom and dad, or maybe you're living with mom and dad and you can't pay your student loans, whatever it is. Regardless, so pretty interesting. Let's talk about rents here. We said this was going to happen. It's happening. Rents drop for 10 straight months, raising inflation concerns. So what happens when people get maxed out, right? They don't have their month-to-month bills to pay, and rent is something that you have to have the cash, right? It's not, you can't go out and get a loan. Maybe people are taking out cash advances to pay their rent. I hope not. That's probably a very small fraction of people that are doing that. But rents are a very good indicator of the true strength of the consumer. Although we're being told the consumer's strong, rents are dropping for 10 straight months. I think that's pretty much in one sentence. That really tells you what's going on there. Rents fell in the U.S. for 10 straight months. The decline is slowing. Well, we'll see. The median asking price for rents is down again from last year to 1,732. That's the median, and they're looking at two-bedroom apartments. 1,732. Wow. But over the past 5 years before that, rents were up over 21%, even more in some areas. But if you consolidate all the areas and crunch the numbers, it's 21%. One more thing before we get out of here. It looks like consumers are starting to get close to the limit here because credit card borrowing is beginning to drop. Even though banks are still happy to give out credit cards and increase credit limits, we're starting to see this drop off here. Credit card borrowing, instead of Market Watch, drops unexpectedly in April for the first monthly decline in 3 years. It's interesting that they're just now reporting April because we're in June here. This just came out earlier, a week or two ago. But total consumer credit still rose at $6.4 billion. So credit's still expanding, debt's still expanding. They're going to do everything they can to keep the system going here, but we're going to stay ahead of the curve here. We're going to be right on top of it for you. Hope every one of you liked this video. Please make sure you are still subscribed. Keep this channel operational, and we'll see you here next time, and we'll let you know about investments. We'll follow the news and the housing market, all that. We're going to be on the front lines here for you. Everybody, thanks for watching. Talk to you very soon now. Peace. No, I still haven't fixed my broken finger. Still looking for a good surgeon. Have a good day. Peace.